I'm Mark Gagan, and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Today's guest is a leader in one of the most innovative and interesting businesses in the market. He was last on the show as part of a duo, but now he's here in his own right. This should all make much more sense when I tell you that I'm talking about Dan Burrows, the CEO of Fidelis Insurance Group. Since we last met, Fidelis has successfully split into the balance sheet insurer that Dan runs and the MGA the Fidelis Partnership, led by Richard Brindle, in a move to a hybrid structure that is the first of its kind. Fidelis Insurance Group has also floated as a public company, completed a secondary capital raise, and is to back the launch of a Fidelis Partnership syndicate at Lloyd's. Many of the above events are once-in-a-lifetime occurrences for most executives. But Dan moves quickly, and the person I spoke to for this interview gave the impression of already being settled into his new roles and doubtless exploring his business's next moves. A listen back to this podcast has confirmed that time spent with Dan is enormously productive. We cover a huge amount of ground, from the state of the market all the way through to the best application of artificial intelligence in the insurance value chain. But I think one of the most valuable aspects of this encounter is that we get to hear Dan speaking clearly for himself and the interests of his shareholders. He does so incredibly frankly and candidly. His views are never ambiguous. So if you would like to spend some very productive time with a key player in one of the most successful underwriting organisations of its generation, please listen on. Enjoy the podcast. Dan, welcome back to the Voice of Insurance.
Thanks, Mark. It's nice to see you again. It's been a while, a couple of years. Lots happened in between.
Yes, that was at Monte Carlo, but there you were joined together with another man who we all know quite well, who's also been on the show since then. And since then, the bifurcation of Fidelis Insurance Group and Fidelis Partnership is fully consummated. And you also been coming up for almost a year since your IPO as well. So a huge amount of change. What's your kind of scorecard of that journey, and how has your day-to-day life changed since then?
So I guess starting with the first kind of look at the achievement, the scorecard, it's been an incredibly busy kind of 18 months, standing the business up on the insurance group side, getting approval from regulators, rating agencies, and also the support of brokers and clients. And without that support, you really don't have a business in the first place. So that was really important to make sure that we onboarded their support. And they've been, without exception, incredibly positive about the journey that both the partnership and the insurance group have taken in the last sort of 18 months.
So I suppose it was almost like being a startup a second time around, of course, because Fidelis had started up many years prior, but in a different guise. Was it almost a bit like starting a new company?
Absolutely, but with some huge benefits along the way, right? So 40% of the staff of the insurance group actually came from original Fidelis. You're onboarding a portfolio without execution risk. I think along the way, I did kind of say, if the CFO and I had been out on the road raising money, here we are, we've raised $2 billion. And guess what? We've just signed the best underwriting team in the market for, 13 years. It's a huge round of applause. Well done. But alongside that, obviously, there are other parts of the build out, getting an understanding into the market with investors around the structure, proving the performance. And I think what we have done in the last 18 months is prove the concept works. The relationship is working exactly as intended. We're able to match the right capital against the right risk. We're very aligned to the Fidelis Partnership, regular contact through all stakeholders in the business on a daily basis. But I think being able to stand the business up, head into a successful IPO in a choppy market, it was very difficult, it still is, prove out the concept with the performance in 23 that has led into Q1 24, ahead of plan, very strong opportunities for growth, profitable growth in the future, a lot of initiatives to broaden the footprint, and then be able to do a follow-on as well, again in difficult times. I just think speaks volumes to A, the people in the business, but B, the support in the market, be it client, broker, investor. So that's all been really, really positive. What I'd say in the second part is, how has the day-to-day changed? Then obviously you do spend a lot of time with investors and that's natural, but a lot hasn't changed. And that's really was the part of the job that appealed to me from day one. I want to be involved with the partnership on the underwriting side. When I get in the morning, we have an integrated underwriting IT platform. I can see exactly what's been written. Richard and I talk daily about risk, and we're involved in the origination. So a lot of things haven't changed. And that was really important to me and to the team here. They want to make sure, whilst we are focusing on our core competencies, we're capital managers, they're underwriting, there's a huge alignment and a huge overlap. And that's beneficial to both sides. So the positives are there every day, very exciting, and we're very pleased.
When I spoke to Richard about 8 months ago, he said, yeah, that benefit for him as an underwriter was great. I've just got so much more time underwriting, meeting brokers, meeting clients, going and originating new business. I get excited, coming up with new products, all that stuff. With you, if the bifurcation's enabling you to spend more time doing things that you're really good at, do you find that you can spend much more time thinking about your investment income and think much more time, obviously, about matching risk and capital? Is that your benefit? Would you say, that be your benefit, that you don't have to spend so much time thinking about other things?
Yeah, and I think that, as we've said before, capital management is a core competency for us. So we look at the dividend policy we put in place, we look at the share buyback, all important kind of management tools when you think about managing capital. But I think alongside that, you still need to understand the underlying business portfolio, market relationships, market cycle. And that just adds to the story when you're talking to investors and how you get them comfortable with who you are and where you're going. So I think we're in the best of both worlds here, because we are unemotional when we think about underwriting risk. We just want to take a clear, concise view of our appetite, our own view of risk. But also we're connected enough to be able to outline to investors what is really going on in the market with confidence.
You mentioned about investors getting comfortable, and certainly it seems that they have been getting more comfortable when you mentioned the follow-on placement there as well. Obviously, MGAs and carriers have always existed and coexisted happily, but this had never been done before. A bifurcation like this had never been done before. Do you think now is a time, it's a reflection perhaps of the success of the follow-on placement, that those investors are getting much more comfortable with what the difference between the two is and what you are?
Mark, you're absolutely right. As a business, when we're out on the road seeing investors now, and we onboarded Miranda Hunter, who's our head of IR, investor relations, and we've spent a lot of time out on the road seeing investors. Around the IPO, naturally, people ask a lot of questions around the structure. How's it working? Commissions? Who does it benefit? Does one win? Does one lose? Well, actually, we both win. We very rarely, if ever, get a question around structure. Now the focus is on market duration, performance, growth aspiration. So the positive things when you're an underwriting business, which we still are, that's what you want to be talking about, not the kind of internal structuring of the business. So we don't use terms like bifurcation. It's a hybrid union of capital with underwriting, and the stakeholders on both sides are a union. That's exactly it. We talk to each other, we work together, we help each other, and long may that continue.
And do you think, well, that valuation, if it's below book, do you think you can go up to premium valuations that other carriers are able to achieve?
I think so. Look, we're very early. We're still within a year of the IPO. So for the scale, for the kind of hybrid nature of what we've done, you've got to give it a bit of time. But that's all about performance. And quarter on quarter, we're beating plan. People are getting more comfortable. We've seen a very steep trajectory in terms of share price since January this year. Obviously, we expect a kind of reset around a follow-on, but the story is very positive. Absolutely, we think we should be a multiple to book, and we see no boundary to that. And I think we also get that with some of the investor sentiment, a lot more kind of long-only profile investors with us now. So they see it as a journey, and I think that's going to take a few years of compounded performance. But yeah, definitely, I don't see why couldn't we be a multiple to book.
I suppose some of those peers do have multiples to book, do so at present market conditions because market conditions are so good. You've got profitable business and the potential for growth, i.e. more profitable business in the future. You've had very strong growth in specialty and reinsurance, and that's been the story of, let's say, the last 12 months. How much longer do you think those favourable market conditions are going to continue?
Sorry to interrupt in mid-flow, but this is just a reminder that you could be advertising right here, right now, and getting your message directly into the ear of key decision makers in the insurance industry. And you'll be doing it while they're absolutely in listening mode. The podcast is the medium of the future, and so is audio advertising. Contact me on mark@thevoiceofinsurance.com, and I'll do everything I can to get you started.
Again, really good point, and an important thing to address here is we're still in the best market we've seen in decades. It is a mature hard market with compounded increases across most, if not all lines, and that positive movement is still continuing. The opportunity to grow actually now, and some of the initiatives we've got through Lloyd's, we've opened an office in Abu Dhabi, so some of it is geographical. There's a big initiative with the BRICS economies. That represents something like 43% of GDP in the next couple of years, so actively pursuing relationships to onboard business there. So I think we still see a lot of growth opportunity, but it's also about managing through cycles as well, isn't it? And I think we've demonstrated the ability to do that with the track record of Richard and the team over the best part of 4 decades. We have a very strong management team here with a lot of experience in managing capital. The use of reinsurance as a fungible form of capital is very important to managing through the cycle. So I'm very confident we can continue with the performance. But right now, we see opportunity for growth. That's where we'll channel most of our surplus capital into, profitable growth. And a lot of initiatives and a lot of hard work's going on to secure that. But I think we do have to strongly underline it is still the hardest market we've been in for 20 years or so, with great margin. And maybe we don't get the cycles we used to have. I think that's something I've heard quite a lot of CEOs talk about in the last sort of 6 months, is these huge swings in prior cycles after dislocated markets just may not happen. And we've still got the driving factors. We've still got conflict. We've still got issues with uncertainty around casualty reserves. We've still got climate change. We've still got claims inflation. Those things aren't going away. And we haven't had a massive inflow of capital into the business. No new startups. Demand is up. So we're very confident that we can continue to grow profitably. You just got to work a bit harder, right? That's the key.
And within that growth, let's say in the last couple of years or the last 3 or 4 years, it could have been quite easy to renew the exact same portfolio and get growth, just compound growth by increasing the price on that portfolio and retaining that growth that way. How much of that growth now going forward is likely to be from some of those newer ventures around the UAE venture, was getting closer to those customers and accessing business that doesn't necessarily come to any of the main hubs where you might already be operating, that kind of thing?
I think they are really exciting opportunities to broaden the footprint. So one thing we won't do is compromise the integrity of the underwriting. There's an incredibly high benchmark, and that would go not only for product lines, but any partner that anyone is talking to. The benchmark with Richard and the team is incredibly high. So we're not going to compromise that. But there are opportunities out there. I worked in Lloyd's for 27 years. I have a lot of respect for Lloyd's as a marketplace. It has a lot of expertise. The rating, the global licensing, the counterparty limit increases we can get through that rating, that all enhances kind of origination channels. And there's a lot of expertise in Lloyd's, right, across many product lines. So being part of that, I think, is an exciting opportunity. But yeah, look, we want to broaden those channels. And I think these are 2 really good first steps in that kind of global pursuit of business. We're not necessarily very good, especially in certain areas of the world, in reaching out and broadening a footprint to other territories and closing that insurance gap. So I think that's something we're working on really hard for the next 3 to 5 years.
We might as well talk about the Lloyd's venture. So is it that main rationale? Is that because I suppose at a certain scale, I mean, if you're a large, mega global insurer, it's perfectly okay to have offices in practically every capital city of every country in the world. But I suppose at the scale that you're at, I presume that Lloyd's is a more efficient way of accessing those 180 markets in which it's got licenses, for example. Is that one of the main rationales?
Absolutely. I mean, I think it definitely gives us access to new clients, new territories, which you just wouldn't be able to get unless we went through a Lloyd's platform. Or, as you say, put a flag down everywhere in the world, which is just not efficient for us. So Lloyd's is a brand name, a global brand name that attracts business, rightly so. And I think Lloyd's is always looking for leadership. Richard ticks that box. So I think he himself will attract business into Lloyd's, which I think, will benefit both parties and others in Lloyd's as well, actually.
Yeah, that's the main rationale. That's what you're really getting out of this. It's that access to a different business that you might not be able to get, or that means of accessing the business through the licensing, that kind of thing.
And just being able to operate in a marketplace with expertise, both on the underwriting side and brokers. I mean, I worked in Lloyd's for 27, 28 years. There's plenty of business that doesn't come out of Lloyd's. And having access to that is really important, and that expertise.
And so it sounds like the potential for the growth of that syndicate is large.
Yeah, I think whilst it's modest in the first year or two, I think potentially growth there, exactly right, Mark, could be significant to both businesses. But again, it's all about, you're still not going to compromise the underwriting integrity, but it will provide a lot of opportunity.
I suppose we need to talk about the reinsurance markets. By the time this podcast is out, we will have been through the second big renewal point of the year after 1/4, 1/6, 1st of June. I suppose market noise, and I think some of the first early brokering reports might be suggesting that reinsurance market pricing, particularly in property cat, obviously because this is a very property cat focused reinsurance renewal, maybe peaking. Is that about right?
You know what? I signed off some of those reports for a number of years as a broker, and they're great marketing tools. But actually, if you wrote the whole portfolio, if you wrote right the way across the curve, and you can always manipulate those things to come up with any answer. But, I always look at what's the market share of that broker? What's in it for them? So I don't necessarily put a lot of credit into any of that. All that said, one thing that is obvious in the market, that not all reinsurers start in the same place. They are verticalized market. There's no denying that. So you want to be a leader in those markets, and we lead the majority of business that we write. We have a lot of private layers. We're a risk selector. We don't write the market. And I think that's important to remember. So we don't all start in the same spot. We don't all write the same business. And we think we have a differentiated portfolio against the market.
So you can still swim against the tide?
Of course you can. Yeah, absolutely. There's been pent-up demand. We're seeing certainly no real new supply into the market, but we're seeing new layers coming in, new opportunities. And we're bullish, right? We're bullish about the market. But I understand why brokers have to say what they have to say. I'm the poacher turned gamekeeper.
No, fair enough. I suppose fundamentally, you said earlier that you are happy. And so presumably, even if rates stayed where they are in risk-adjusted terms, you'd have to still be happy, wouldn't you?
I think we've been a beneficiary of compound increases for a number of years now. And that's why we talk about this mature hard market. So yeah, we still see positive movement and there's plenty of margin. But let's not pat ourselves on the back here, right? We've had one good profitable year. Now is the time for discipline. We think the casualty uncertainty around reserving should help to hold that discipline in place. So don't grow for growth's sake. Be profitable. Let's all make a margin. And we still think we can do that, and with positive movement.
We've had Q1 results across the market. There's a market-wide loss, the Baltimore Bridge loss. The takeaway from that, from reading all those reports, and everybody's Q1 reports would say, it seems like it's sort of what we're here for kind of loss. It can be a big loss, but it doesn't sound like it's the sort of thing that is causing any trouble or causing, I suppose when things go wrong in insurance, it's because something that you didn't expect to happen. But this sounds like something that I suppose, yes, we don't want it to happen, but a ship crashing into a bridge is a perfectly normal thing to happen. And it happens fairly regularly. You hope it doesn't happen to the extreme degree that it happened this time. But it sounds like the market's basically able to handle it. It doesn't sound like it's a shock to the market. Is that right? Because I don't want to be putting words into your mouth, but certainly that's my reading of the industry response to the loss. And it's been distributed in a fairly sort of standard way. I suppose the other thing about a large loss is sometimes you could see the odd player has got a multiple of what their market share is of that loss, and strange things are happening. But here it doesn't seem like anything like that is happening. It all seems to be by the book.
For marine, this is a large, very complex loss. It's a very interesting loss, and it's going to take a long time to sort out, as we all know. But we've just been through a follow-on. The questions you get around that market is, will it move the market? And our answer is, generally, what moves the market, what creates shock, are capital events. And this isn't close to being a capital event. There'll be tornadoes in the last couple of weeks that, from the ground up, will be much bigger events. So, yes, it's a big loss for marine. It's a big risk loss, but it's not a capital event. Let's get it in context here. It will take some time to sort out. It is very complex, but it's, for us, we look at it as a very manageable event.
When I look at those Fidelis numbers, which are obviously always good reading at the moment, I look upon you as quite a traditional business in that you buy quite a lot of reinsurance.
Yeah.
Some businesses are sort of, very, very net, but you're not. You remind me of like a Lloyd's business from 20 years ago that you'd see quite a large amount spent on reinsurance. Obviously, the reinsurance market's reset over the last couple of years quite dramatically. Has it affected your ability to trade? How much of it sort of is the reinsurance tail wagging the Fidelis Insurance dog? I've just called you a dog, by the way. Not the intent. It's just a metaphorical expression.
I like the results at the moment. Let's have some conviction here. We can manage that through the cycle, right? If there is one. But, we're very open about, we do use reinsurance as a fungible form of capital. I think the Travelers 20% quota share. We buy a lot of proportional. We trade a lot proportional with partners that have been with us for a long time. We've known them in prior lives. They're very broad supporters across many lines of business. The gross line is important to us because it helps us drive the leverage through scale that we need to get the terms and conditions that we want, that in turn benefit our reinsurers. So they bought into that. They want to back leaders in the market. They back Richard Brindle and the team. That makes sense. And the performance speaks for itself. I think across other lines, we pretty much buy every tool in the toolbox. So we think about index, ILW, cat bond, alongside the proportional. We buy a lot of non-proportional. And yeah, we've seen movement, but we're able to marry that into our margin. We see improved margin. I think, and talking to others in the market, retro market's hardened a bit in the last 6 to 8 weeks. So also some of this commentary you're reading is a bit premature, right? We've all seen comments around the cat bonds, the index products. There's definitely been some hardening. There hasn't been a lot of money pulling in. There is more demand. So It's going to be an interesting running for the rest of the year, I think. The key is you've got to manage those relationships. Don't do things in isolation. I ran the biggest retro team in the world for a number of years, as you know. And the important thing is to embed your clients, your core reinsurers across the portfolio, give them diversification benefit, and they'll stick with you and communicate. And we do that very well.
I suppose to summarize your answer about that is that you've got these great relationships and they're very long-term relationships. You really understand each other. You're delivering for each other. And therefore, it was less of a question. When you come into renewals, okay, the market's difficult, but it's not going to be difficult for me because I'm top of their list. Is that more the sort of relationship?
Yeah, that's where you aim to be. That capital should migrate to the leaders that perform in the market. And I think we can demonstrate that.
And again, I suppose the other rationale is that market relevance. I suppose there's no point phoning a broker up and then at the end of a 3-hour negotiation, you can only offer them a 1% line. We've all been there as brokers, haven't we? Yes.
Mark, you've been out there, you've done it. It's not, thank you for that, but that's 99 to go.
And so you're much more likely to be able to dictate terms if you can solve the problem or put down the biggest line.
And articulate your process, your sweet spot, be responsive, be there, right? And I think that's how we differentiate. We don't work in a solid environment. UMCC calls are really important, but providing a service alongside that leadership and scale and leverage is equally as important.
What was that abbreviation just used? Was it UMCC?
UMCC, actually, the daily underwriting call at the partnership, and there's maybe 2 or 3, depending on the time of year, every day. And you'll get all of the underwriters on both sides. You'll have claims, legal, compliance, and it's a chance to review every risk. It's a chance to challenge, to cross-sell, to leverage deals. And I think that's really sets us aside.
Probably one last question on growth. Obviously, we've mentioned about platform growth at Dubai office, Lloyd's syndicate. What about in terms of the classes of business that Fidelis underwrites? Are you kind of built in that sense? Obviously, there's by product line, there's by geography. But in terms of product line, do you think you are built? I mean, not a casualty player. You've mentioned about that casualty reserving. If that became a bigger issue, do you think you could ever break the habit of lifetime and move it slightly away from short tail? It would never be moving away from short tail, predominantly short tail. But could it ever tempt you, do you think, under any circumstances?
We write nearly 100 lines of business and we still see a lot of opportunity there. Where we don't write, we're always analysing rate adequacy. Can we get something to work for us? But the benchmark is high. It's the same with other partnerships, right? The benchmark is incredibly high. Casualty in itself, we look, there may be some niche things. I don't see us ever being a general writer of casualty, but never say never. Of course, there's an inflection point where things get interesting, but we still think there's a long way to go. And we don't actually see big enough improvements in the market to make it that tempting at the moment.
It does seem to be very patchy, yes.
Yeah, but there are great underwriters, great partners in that line of business, but they're probably more in niche areas.
Let's face it, we're not at a liability crisis point, are we? We're not like the mid-80s. We're not founding ACE or XL of today, are we? The market doesn't seem to be there.
No, but we watch it with great interest. As you know, there's plenty of noise. Going to conferences this year, investor conferences, it has been quite interesting to see the amount of time or bias there has been to casualty, far more than the property side, actually, which for us has been very interesting.
Watch this space with interest, because yes, you never know.
That's the strap line.
Well, I suppose it's a bit like that famous Hemingway quote, isn't it? It's like, how did you go bankrupt? Very, very, very slowly, and then suddenly all at once. It is a motto that is probably more applicable to casualty than it is to property.
Look, the market is very good and plenty of margin, plenty of opportunity. You just got to work hard. That's always been Richard's mantra in the team. We've always worked really, really hard. I was talking to Richard the other day, actually, around service, and he actually gave us an example of a client that had come in from the Far East and had arrived in London the day of a train strike. And of all the reinsurers he was supposed to see, only 2 came into the office. We were one of them. Now, that, I think, tells you about the differential in the market attitude. That's why providing service is really important. That's just an anecdote of why it's important to be responsive, be there, see your clients, see your brokers, because people remember these things.
I suppose, of course, you have to give service to the partnership, don't you? So there's no point them innovating and then if you're not available to say, yes, of course we can do that on the capital side, then I suppose you've got to maintain your own level of service to the partnership, haven't you?
Absolutely. And I think that's why having aligned stakeholders that communicate every day, it's not just one business plan annually, come back to us when you've executed that. It's an ongoing process that evolves. And through the ROFA, the right of first refusal, everything that comes to them has to come to us first. That's where you need to be responsive. right? We don't want them ever to miss an opportunity because we weren't there. That's not how we work. So we're very front foot, but we're engaged early as well. And that's the other critical thing. It's a very intimate relationship. And because of all these contact points, because you're talking to Richard every day, you're picking things up and you're able to work in real time very quickly. So we're here to support them in that. And they are excellent at originating. They really are.
It was at least 3 years ago when I remember I had Charles Matthias on the program. We were talking about technology then, about you having a slightly differentiated view of how technology or certainly should be embedded into all the things you do. And then 3 years later, of course, now everyone's talking about AI, etc. And we couldn't really have a podcast in 2024 without me asking a question about it and where you see the application. So what are you up to with AI at the moment? I think it's fair that you've probably been up to it for longer than most people have.
Yeah, and I think, again, really important topic for the industry. As you know, the majority, if not all of the deals we do are large, complex deals that need underwriting expertise. So to actually drop them into the world of AI is incredibly difficult. Where we see AI is more around reporting, exposure management, obviously very useful for homogenous lines of business, personal lines, motor, homeowners. But for our complex lines, not helpful, but great in understanding exposure. And that's why we've developed, as Charlie rightly said 2 or 3 years ago, proprietary models and proprietary tools to do exactly that. And they're ongoing, they're always evolving. We see a lot of operational benefit, and that's really important. Operational resilience is something that you have to be particularly focused on. And I think AI has really helped us through that. Things we're looking at there, working in tandem with the Fidelis Partnership as well. So we have a lot of integrated systems and we'll continue to use them where we can. But I just reiterate, for the large complex risks that require the expertise, it's a more limited role for AI, I think. But for the industry, really important to create efficiencies.
Yes, obviously, you on the capital management side of things and exposure management, is that where you're seeing the biggest benefit? And is it more an investment in skill, i.e. getting better at what you do day to day? Or is it more an investment in productivity, i.e. being able to do a bit more of the same? Or is it a bit of both?
It's a bit of everything. It has to be. And broadening your capabilities, that's a critical part of it. Is it allowing you to improve your management information, management reporting? But I think it encapsulates lots of things, but you've covered most of them. But you've got to embrace it because it's really important.
I suppose the other application is by going and finding out third-party information that validates some of the things that you're seeing in front of you, your own information. Because, as you hinted, at this level of insurance, we're talking about very bespoke things that can't be like car insurance or can't be homogenous risks, just large number of small value things aggregating into big numbers that are manipulatable in that way mathematically. But these are bespoke things that need to be looked at individually. But could you use third-party data to help go and dip into a bigger pool of data when, you've only got one oil rig being shown to you or one portfolio of oil rigs, but you could go and get much better oil rig data from somewhere else?
Yeah, absolutely. If you can codify and replicate good process, and then you use AI to expand that footprint, then yeah, absolutely. And that's what we're looking to do.
What about automating underwriting in any sense? Do you think that's never going to be something that you'll ever do, or something where you might actually remove humans from the equation?
I think for the risks, the complexity of the risk, the relationship required, the cross-selling, the leverage that's required, that underwriting call is our AI in a nutshell. That is the innovation deck that we have.
The AI doesn't have a relationship with that broker, and the broker doesn't necessarily trust the AI.
Yeah. And there's history. There are the ability to cross-reference across different underwriting skills. That's difficult to put into AI. Maybe somewhere in the future you can do that, but I don't think any of us here will have to worry about that.
You can't do just trading. Say, well, I'll do this if you give me some of the other things that you haven't been giving me that that I want.
Exactly. You know how we operate. That is our AI, the underwriting call. That's where we can leverage the scale, the relationships, market knowledge. But what AI does do is make sure you focus on being relevant and making sure that you're pulling in those data points. So yeah, you make a great reference to, could you get more offshore rig information from another data point? But also on these calls in real time, what are you pulling back from the market and how are you communicating that to the broader team? So that's really important.
Well, Dan, I've come to the end of my list of questions. I think we've chatted around all of them. I suppose the only drawback to having an audio-only podcast is that none of the people listening can see the smile on your face, which is good to see. You've come through all these extraordinary things that are not day-to-day. Most people don't do an IPO more than once in their lifetime. Most people don't do what you've just done over the last 18 months. So it's good to see the big smile that you're back more on the day job and very much looks like you're really enjoying it. So we'll have to book in another catch up because, again, you tend to move quite fast. Now, every time I think I've got all my questions sorted out, you were doing something else. So I had to keep ripping up my original plan and then coming back with new ideas. So thank you so much. I've really enjoyed chatting to you.
I always like to come back to you with updates, Mark. So we look forward to talking again. It's a positive environment. We've got great people and, that's the battle one. You've got good people around you. And these things are difficult to do, follow-ons, IPOs, they're challenges, right? If you've got the right people around you and you've got a good story, then it puts a smile on your face.
Well, it's really, really good to see that. And we'll be in touch soon.
Thanks, Mark. Take care.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.